All right, let's get started. I'm Will Woodall. I'm here with Mike Rarey from CAP STRAT. Good morning, Mike.
Good morning, Will.
It's a great week. It's Masters Week. We're going to date this video, so it's Masters Week, which is always a fun and exciting week for us here. Also, we thought it would be an interesting discussion to have with everyone on recessions because it has now become one of the hottest things you see on TV and on the internet. Are we going to have a recession? And there's a lot of misinformation out there, and we thought it would be really helpful for us to share how we view recessions. Recessions is one of the key fundamental ideas in our investment framework, that recessions matter and avoiding recessions from an investment standpoint matter. So we have our own proprietary recession framework, and today we're going to share it with you. So let's throw the first chart up and look at the elements that comprise of our recession indicator. And Mike, why don't you take us through what we have here?
Yeah, a tremendous amount of studying academic research around recessions, how they work, looking into various indicators. We basically narrowed it down to 13 that we think really matter and have really strong predictive properties. And when you look at these items on the page, they fall into three categories across three basic forecast horizons. So the first types of variables that we look at are market-based indicators. These things typically move first. When we talk about markets, we talk about the S&P 500 index, credit spreads, things like that. Then we have economic data points. So very cyclical economic data points that typically lead recessions. There are things like heavy truck sales, for example, private housing starts. And then finally, there are some best-in-class recession indicators that we put in our recession indicator. So the New York Fed, the Cleveland Fed, for example, Bloomberg, they have recession indicators that also are pretty effective. And these different types of indicators have various forecast horizons. So we'll sort of work this page from top to bottom. The first things we look at, these are the items that have a pretty long or medium lead time in terms of predicting recession. Now, when we're talking long or medium lead time, we're talking like 9 to 12 months. Okay? It's almost impossible to predict a recession more than 12 months in advance because the economy is so dynamic and so much can change in such a short period of time. You really can't even come close if you're talking about a time period outside of 12 months. But these top variables here, the first, WTI crude oil. So when you see a significant increase in the price of WTI crude oil year over year, that has preceded every economic recession since World War II. Now, we have had some large increases in crude oil prices that have not been followed by a recession. But this has typically preceded all recessions. And the reason there is, if in the US we're spending more money on crude oil, that means we have less money to spend on other things.
All right. And Mike, what does the 51.3% figure indicate?
Yeah, that 51.3%, that's the most recent reading. So WTI crude oil prices on an inflation adjusted basis year over year are up 51.3% right now. And that we have highlighted in red because that's contributing to an increased probability of recession over the next 9 to 12 months. It sort of met that threshold.
Great.
The other items here in the long basket, the next one down is the percent of the yield curve that is inverted. Yield curve is a great long-term leading indicator of recessions. We look at yield curve pairs, so the difference between the yield on the 2-year and the 10-year, the 5-year and the 10-year, the 10-year and the 30-year, etc. When you start to see inversions, which means shorter dated yields are higher than longer dated yields, that is a great leading indicator of recession. So we look at all the pairs across the entire yield curve. Right now, 14% of all yield curve pairs are inverted. That's yellow. That's not at a point that's screaming recession, but it is contributing slightly to the probability of recession in the next 12 months.
And are there any pairs that are more important than others?
Yeah, we call the yield curve the smartest economist in the room, but to be very exact, the smartest yield curve pair is the difference between the 3-month Treasury yield, which the Fed controls, and the 10-year Treasury yield, because these things tell different things. The 3-month is telling you, has the Fed hiked interest rates too much? And the 10-year is, if it's below the 3-month, it's yes, they have. and we could go into a recession. So that's like the smartest economist.
And right now, that spread is
that spread is pretty wide right now, about
very steep.
1.9%. Yeah.
Very steep.
So that's why this is only yellow right now. We have heavy truck sales. So those are pretty good medium to long indicators, seasonally adjusted year-over-year change in heavy truck sales. This is a very cyclical element of the economy. So right now, year-over-year, heavy truck sales are down 23%. That's red. It's important to note why they're down 23%. A lot of that has been supply chain issues, not necessarily a lack of demand. But regardless, that is contributing to recession probability.
Great.
And so then we have medium indicators and shorter term indicators, and we can sort of go over these at a higher level, since none of these are significantly contributing to recession probability over the next 12 months. So in the medium term bucket, we have the New York Fed and the Cleveland Fed, which also use the yield curve. They're implying, a 5.5% or less probability of recession in the next 12 months. New orders to inventory. This is important because it gives you a good lead on where we're at in the inventory cycle. So when this ratio is high, it would be green, because there are a lot of new orders and there's not a lot of inventory. People are restocking inventory, which adds to GDP growth. When that flips, new orders drop, inventories are elevated. That's going to detract from future GDP growth. Right now, that's a 1. Basically, they're balanced. So no real signs to worry there. Private housing starts, and then also the S&P 500. What is the S&P 500 today as a percent of its 52-week high? The stock market, we always say the stock market has correctly predicted 20 out of the last 10 recessions. Meaning, you can have sell-offs in the stock market trying to front run a potential recession that ultimately doesn't happen. And you would see that this indicator, the S&P, is 95% of its 52-week high. Another way of saying that is it's 4.9% below the all-time high right now. So that's sort of yellow. It was more yellow approaching red, in March and February.
So these indicators right now are not signaling any high probability of recession coming. The data can change quickly. So before we move to the next slide, I think the first question I would ask for you to explain is, explain the difference between a recession and a significant or material slowdown in the economy.
Yeah. So a slowdown in economic growth, if you can correctly predict that is still valuable in terms of managing portfolios. And a lot of times markets will move very similar, behave very similarly, anticipating a slowdown in growth versus a recession. So it's important to be able to predict those, but a recession sort of is a line in the sand. It's a totally different regime. It's when you get this feedback loop of survey data and soft data impacting actual economic data, which leads to worse soft data, which leads to lower consumer spending, lower investment. So it's this vicious negative cycle. And so recessions sort of are their own animal. And that's why that's why predicting them is so important. If you can predict recessions and avoid the negative the negative consequences of recessions for your portfolio, you kind of don't even need to worry about predicting rises in economic growth or slowing in economic growth. Like, recessions are that meaningful.
Yeah. So let's throw up the next chart and look at sort of the recession indicator historically and how it has tracked this, because what you'll notice is the data can accelerate quickly. So take us through how this works.
Yep. So the blue line from 0 to 100 shows the probability of recession. And this is a composite of all our recession indicators forecasting across 5 different time horizons. So 12-month, 9-month, 6-month, 3-month, and then right now, are we in a recession right now? And so what you typically see is the thing that first starts to trigger a probability of recession are the longer term indicators, like we're seeing now. So if you look at that table to the right, in the next 12 months, those longer term indicators within the recession forecast are saying about a 19.8% chance of a recession in the next 9 to 12 months. And then if this continues to go the wrong way, then you start to see some of those medium term and shorter term indicators start to flag potential recession. We're not seeing that right now. But next, you would see the actual economic data start to break down. You would see markets start to show more signs of stress. And that's when the blue line starts to accelerate higher. And then when it reaches 100%, that's basically when all the data confirms we are currently in recession, or a recession is imminent within the next 3 months. And that is still valuable information. You think, okay, 3 months isn't much lead time. But the reality is, even if you can predict a recession with absolute certainty 3 months in advance, you can still avoid a lot of negative consequences in asset markets, equities, bonds, et cetera. So it's still very valuable information. So that's how you see this accelerate so rapidly, because markets, a lot more market-based indicators are in those shorter term time horizons, and high yield bond spreads can blow out, 200, 300 basis points in a week, and that can contribute considerably to recession probability.
And is there a level of on the composite recession indicator where it's sort of okay, we're heading that way, and it's the probabilities are almost 100%?
Yeah. Yeah. Sort of the point of no return. Once we see the composite indicator exceed 50% chance, then it's almost always been followed by a recession. At that point, the data has started to break down so significantly that it's going to beget further breakdowns in data, and we're probably going to end up in a recession. So the one sort of false start or false prediction you could see is in 1998, 1999, the composite got up to about 60% because there was a lot of market stress that was around, Asian currency crises and Russian sovereign default. And the Fed and other central banks were able to avert that recession. It wasn't imminent because they were able to provide more stimulus, lower interest rates, et cetera, and take care of a lot of those market-based indicators and sort of get markets back on good footing. But you could see the damage was pretty much done shortly thereafter. We did end up going into recession in the early 2000s.
And what, in terms of the market, sort of the expectations for market returns, would we look at in a recession, and when does the market start to sort of price in the recession?
Yeah. So the thing that sort of gives you a big warning shot is usually the equity market. And so there you typically see a drawdown of 10 to 20%. And that's sort of, all right, there's a real risk of recession here. But you usually don't see the next big leg down in equities until the recession actually happens, until you're in it. And then, it's a pretty wide range of outcomes, but you're generally down more than 20 and less than 50, somewhere in there on equities. And then the equity indicator, once again, it's always pricing in future information. So once it's confirmed that we are in recession, the market is down significantly, and importantly, we use this recession indicator to forecast when we think we'll exit recession. So once it becomes clear, all right, 6 to 9 months from now, we're not going to be in recession, that's actually when you want to start buying equities.
Right.
It's very uncomfortable time to buy equities when they've just been down a lot and you're in recession. Right. But that's typically the best risk reward because prices are so cheap.
And I guess another uncomfortable period is that period from the first signal until the recession, where you can get these major bear market rallies that can sort of chase you out of things, positioning for a recession. And how do we use this indicator in our investment process?
Yeah, so there are a number of things that matter in our process. So the first is price you pay for the asset. The next is the liquidity environment, so money supply growth, what regime we're in. Next two are growth and inflation. And then finally, recessions. And recession is the last factor in the process, but it also is the most significant. If the recession forecast has triggered and we think we are going into a recession, that is a much more powerful signal. It basically overwhelms all the other factors. At that point, you want to get more defensive, reduce equity risk, look at longer duration type bond assets, and really focus on that to guide portfolio positioning as opposed to the other indicators.
Great. We definitely are going to use this recession indicator more in our communications with you and our clients to make sure you understand how this evolves, because the data does change monthly and can be pretty volatile. So we'll keep you up to date on that. If you have any questions, certainly reach out to us. We're happy to go through it in detail. And until next time, have a great day.